Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Today on the podcast, we have Jay Scott. Jay is a partner at Bar Down Investments, focusing on purchasing and repositioning large multifamily projects. He's the author of 5 BiggerPockets books on real estate investing, and he's also a co-host of the award-winning Drunk Real Estate Podcast, a podcast I really enjoy listening to. Tons of great data, lots of fun. Jay is someone who shares a lot of economic data that's incredibly informative and easily digestible. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated, if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
Welcome, Jay. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, absolutely. Thanks for having me, Gary. Thrilled to be here. So I come from the business tech world. I was an engineer in Silicon Valley for the first half of my career. 2008, I left tech, moved back to the East Coast with my wife to start a family, and we fell into real estate. And so for the last 16 years, we've been doing real estate. We spent about a decade in the single family world. And then around 2018, we transitioned to multifamily. And now I am a partner at Bar Down Investments, and we syndicate large multifamily properties.
Awesome. Well, why don't we start with, the rate cut of 50 bips yesterday, 2 days ago. As a real estate investor, we've been waiting for this for a long time. What does it mean for real estate?
So that's a really tough question because it means a whole lot of different things. I assume that the first question most people are going to ask is, what does it mean for rates, mortgage rates? And a lot of people had the expectation that as soon as the Fed dropped rates, that we would see mortgage rates go down, hopefully by the same amount, half a percentage point. Unfortunately, that hasn't been the case. I don't think those who really follow the way rates work expected that to happen. So mortgage rates are driven by 10-year Treasury bond, not the Fed's interest rate. And the 10-year Treasury bond basically already responded to the expected Fed interest rate drop over the last several weeks. So we have seen a drop in mortgage rates over the last several weeks in anticipation of the Fed rate cut. But we haven't seen we haven't seen much in terms of additional drops since the Fed rate cut. And I don't expect we're going to see much from this cut. That said, Fed's likely going to do a couple more cuts over the next 6 months, and that could drive rates down a little bit more. Then the next question is, how is this going to affect things like home values or commercial real estate values? I think in the single family world, I don't think it's going to have much of an impact. General consensus out there is that we need rates below 5.5%, maybe 6% before we entice any homeowners that have low long-term mortgages to get off the fence and decide to sell their houses. I mean, data shows that there's about 72% of homeowners out there with mortgages at 4% or less. Not very enticing to sell your house with a 4% mortgage or a 3% mortgage or a 2.5% mortgage. Just have to go and buy a house that's horribly overvalued with a 6% mortgage. So I think at some point rates will come down enough that it'll get sellers off the fence to consider to start selling. It'll generate some more inventory, and that will probably push or at least put some pressure on prices in the downward direction. But for now, I don't expect this to have any negative impact on housing prices. If anything, we'll probably see more buyers come out of the woodwork, and we'll see more buyers for the small supply of houses we have, and that could push prices up. In the commercial space, I think this will probably be good for cap rates. If the Fed lowers the federal funds rate, that's probably going to push down the 10-year Treasury rate a little bit. And the 10-year Treasury rate is kind of this alternative investment or alternative rate that investors look at when considering, should I be investing in real estate or the stock market or whatever. And if the 10-year goes down, typically it brings down the cap rate or the trading rate of other asset classes as well. So the half point drop could have a small effect on cap rates. I think it'll help us start moving cap rates in the correct direction. And then from the mortgage side of the commercial space, it could have an impact. So we look more at the SOFR curve or maybe even the prime rate for certain types of mortgages than we do the federal funds rate. But with the federal funds rate coming down, it's very possible that we're going to see those other rates start to come down, and that could have a good impact on those rates. And then most importantly to me as a multifamily investor is the Fed taking this action provided some confidence in the market. It lowered volatility. So basically investors are less scared, institutional investors are less scared. And when volatility comes down, the price of rate caps, those insurance products that we're forced to buy when we get floating rate debt, comes down. And for anybody that's owned properties with floating rate debt over the last couple of years, we know that those insurance policies can be tremendously expensive, can really hurt our ability to make a profit on these properties. And so rate cap prices coming down, which I think will be the biggest winner from this interest rate drop, could help us considerably.
Yeah, absolutely. And just to give perspective to our listeners out there, I was looking at a deal, I think it was 8 weeks ago, when we were low sixes. And, over that time, we were in the low fives, not including a buy down. So, I mean, a huge swing. You're talking about 110 bips on a mortgage of, 10 million plus is massive. Yet the beauty of it is the cap rates haven't come down yet. And so, I mean, now it makes for a really great time to buy, because you're just getting a great rate and not paying for that massive upside. The rate, the cap rate.
Yeah, I mean, everybody talks about you buy low, you sell high, and I think we all think that's a really obvious thing to do. But then when you get in the midst of buying low means you're buying in a market that's probably going through some turmoil. You're probably dealing with some fear and some anxiety and some frustration at whatever the market conditions are. And it's hard to bring yourself to buy when prices are low. On the other side, it's like when things are going crazy and prices are high and everybody's looking to buy, that seems to be the time everybody wants to buy. And that's where we get in trouble. It's a lot easier psychologically to buy when prices are up because we feel good about the market. It's harder to buy when prices are down. But the reality is we all know that you should be buying low. And I think this is going to be the opportunity over the last year into the next year to really buy low. And I don't think we're going to see the multifamily market come back quickly. I don't think it's going to have a run up like it did a decade ago through 2021. But I think we are on the upside, and I think we're going to continue to push upwards over the next several years.
Yeah, absolutely. So obviously, they cut the rate. Well, a lot to do with the job market. Obviously, inflation has come down. But what other cracks are you seeing in the economy? Because it's not just because when rates come down, when they cut the Fed, everyone thinks that everything is great, but that's not the reason why.
Yeah. Well, so historically and normally, the Fed uses rates to respond to changes in the market. So if the market gets soft, if jobs are bad, or if the GDP numbers are low, or whatever, if things are bad in the economy, the Fed can lower rates. Lowering rates gives us incentive to borrow more money because we have lower rates. rates, it gives us less incentive to save money because we're not getting any money in a savings account or a CD. And so people are out there borrowing money and spending money, and that spurs the economy and helps the economy. And then vice versa, when the economy is going really strong and we start to see inflation from a strong economy like we did a couple of years ago, raising interest rates slows people from spending and it slows down the economy, which is what the Fed wants when there's too much inflation, to get inflation down. And so we're used to the Fed changing interest rates in response to market conditions. That certainly happened here to an extent. So the jobs numbers are starting to look a little bit weaker. We had a big revision through last March of over 800,000 jobs. So it looks like jobs weren't as strong over the last year as we thought they were. We're seeing some other potential cracks in the market, mostly around this wealth gap. So the middle class, and I can use the cliche, the middle class is going away, but the data actually supports that. So we've seen about $6 trillion over the last 4 years flow out of the middle class. About half of it has gone up to the top 1%. About half of it has gone down to the bottom 50%. So it's getting spread out, but that middle class is starting to disappear. And I think that's not a good thing for our economy long term. And we typically see the middle class kind of get decimated during times of high inflation. And so part of the reason that the Fed had to raise rates at the pace that they did was to avoid that any more decimation of the middle class. So certainly the Fed is moving rates in response to what's actually going on in the market. But there's another thing to consider. In when it comes to interest rates, there's this thing called a neutral rate. And the neutral rate is that interest rate where the economy is kind of running optimally, where you're generating enough borrowing and spending that we're seeing economic growth, but we're not generating so much that we're seeing too much inflation. Basically, the Fed tries to do two things. They try and keep full employment. Basically, they want everybody that wants a job to have a job, and they try and keep prices pretty stable. And there's some optimal rate that we call the neutral rate where that occurs. Problem is, nobody really knows what that rate is, but we do know that it's lower than the 5.25% that the market's been at, that the federal funds rate's been at for the last year and a half. And so because we know that the neutral rate is below 5.25%, that means if we kept rates at 5.25%, we would necessarily see a slowdown and the economy would start to degrade. So part of what the Fed was trying to do by lowering rates was trying to get closer to that neutral rate, which I'm guessing they think is somewhere in the 3 or 3.5% range, just so that we can basically come in on for that soft landing. We can get a stable economy. And so I wouldn't have been surprised had the Fed started to drop rates 2 months ago or 6 months ago, even before we started to see these cracks, simply because the Fed knew that this optimal rate, this neutral rate, was a good bit lower than where we were. And so their goal is to kind of slowly get us down to that neutral rate and figure it out in the process.
Yeah. And we all know that they always move quite a bit slow than they should.
Yeah.
What are, like, as a real estate investor, what are the most important data points that you look at?
So for me, I always think about who are my customers. My customers are my tenants. And my tenants, they pay me thanks to hopefully them having jobs. And so the biggest thing that I'm looking at is the job situation, because I know that is going to be the biggest impact on tenants' ability to pay. Obviously, inflation was a big one a couple of years ago. Inflation was the big data point we were all looking at. But these days it's jobs, because I know that if we see a deterioration in the job situation, we're going to see increased vacancy. We're going to see increased bad debt and delinquency. We're probably going to have higher turnover costs. And so that's kind of the main data point that I'm looking at these days. But I'm also looking at expense growth. So right now, I don't expect to see a lot of income growth, a lot of rent growth over the next year or two, simply because we still have inflation even though inflation's not high, prices are still high. Prices went up a tremendous amount the last couple of years, and those aren't coming down. So even though inflation is down, that growth in prices is slowing. The high prices are still here. And what we're seeing is that a lot of tenants I'll use me as an example, but this is true for many landlords across the country. We have this benchmark where we only accept a tenant if they're making 3 times their monthly income in their monthly rent in income. And what we're seeing is that thanks to inflation, thanks to rents going up tremendously quickly over the last couple of years, but wages not going up nearly as quickly, what we're seeing is that many tenants are paying somewhere in the 30 to 31% of their wages in rent. And when that gets to a 33% number, they no longer qualify for our properties. And so we can't, even if we wanted to, we can't raise rents any higher unless we were to compromise on that 3-to-1 ratio of income to rent. And we like to be careful with our properties. We don't want to bring in tenants that we think aren't going to be able to pay. So we try and stick to that 3 times number. But if we stick to that 3 times number, we're going to see smaller rent growth for the next couple of years until wages catch up. And so there's a cap at this point on rent growth, I think, for the next year or two, but there's no cap on expense growth. And so we still have 3% inflation. So labor and materials are still going up at 3%. Insurance costs are still going up a good bit. Property taxes in some areas we're still seeing go up. And so, yeah, I think that one of the big risks that we have and that we have to keep an eye on is the expense side of the ledger. And I think we all have to be really, really careful about not spending more money than we have and being really frugal these days, running our properties well, but not throwing away money and being very efficient.
Yeah, I think that's been the double-edged sword, or getting hit from both sides in the last 12 months. You've gotten a little bit more vacancy, a little bit more delinquency, a little bit more concessions on the income side of things, and then on the expense side of things, yeah, higher real estate taxes, insurance. Even we're seeing that even in Arizona, where we don't have as many issues, but we're helping to pay for other parts of the country. I mean, we're getting massive jumps in insurance costs. Then obviously you've got labor, supplies, other things too. So your income is going down, your expenses are going up, your debt service has been going up. So it's been really hard for real estate investors over the last 12 months or so.
It has been. The nice thing is, again, I think for those investors that bought before 2022, if you've survived this long, I think we're in a pretty good place. Again, the biggest risk right now is those rate caps, those insurance products. As they expire, we have to buy them, or we often have to escrow a year in advance. But I suspect those prices are going to start going down drastically from this point. And just interest rates themselves, thanks to the recent rate drop. If your interest rate is based off of prime or SOFR, that's likely to go down as well. So I'm not saying everybody's out of the woods at this point, but I think a lot of people can breathe a sigh of relief if you've made it this far and you're not delinquent on your mortgage and you're not facing foreclosure at this point. You're probably in a much better position than you were 2 years ago.
And there had been so much talk in the last year and a half about this kind of tsunami of distressed debt that just really didn't materialize. There were workouts. Obviously, there's been some foreclosures, capital calls, and whatnot, but really a very, very small percentage. And I just don't see that, that tsunami of distressed debt coming because of interest rates now finally falling.
Yeah, and I think I'm not saying that there's not some risk there, especially in other sectors like commercial, but just to put the numbers into perspective, right now there's about $1 trillion, maybe $1.2 trillion of multifamily debt out there. In any given year, we're seeing about 150 billion of that coming due. And so I think it's right around 150 billion coming due in the next 12 months. That's not a small number. But just to put 150 billion into perspective, if you remember the last big bank failure, Silicon Valley Bank, last March, a year and a half ago, that was a $200 million bank failure. And it didn't move the needle. The Fed swooped in and it bailed them out, and everybody forgot about it 2 weeks later. So 150 billion is a lot, but another way to put that 150 billion into perspective is it's estimated that there's about $300 billion in money sitting on the sidelines to be invested in real estate. Investors have about $300 billion sitting on the sidelines. So if every single one of those $150 billion loans that were due to come due in the next 12 months were to go into foreclosure, and the reality is it's going to be closer to 1 or 2%, but let's say it was 100%. If every single one of them went into foreclosure, there's twice as much money than what's needed, sitting on the sidelines that would likely swoop in and bail it out. So I think we would have to see multiple years of very high delinquency and foreclosure rates before we saw anything that even came close to amounting to a big risk for the sector.
Yeah. Yeah. I mean, I'd love to be able to swoop in and grab some of those deals myself, but
Would love
the
it.
reality is it's not going to happen.
No.
What do you see real estate investors, what some of the biggest mistakes they make investing in real estate?
So in general, I mean, the biggest mistake I see is just getting in over your head. So, I mean, you can, if you buy a single family house and you risk $20,000 or $30,000 of your own money, maybe 100 or 200 or 300,000 with a loan, yeah, that's bad. You can hurt your financial future for a bit. But that's not nearly as bad as jumping in and buying a 10 or 20 or $30 million property, raising $10 million from investors, and not knowing what you're doing. And so first thing I would say is don't get in over your head. Second thing I would say is that there's a lot of education out there, which is fantastic. But unfortunately, a lot of that education focuses on the front end of the business. So the finding the deals and figuring out how to raise the capital. Very little of it focuses on the most important part, which is operating the properties once you get them. I think part of the problem is that we think the purchase of a property is the day we should be celebrating. And don't get me wrong, we celebrate when we purchase a property too. Everybody celebrates a little bit, but that's the starting line. That's not the finish line. And I think newer investors really need to keep that in mind. That if they don't really know how to run a property, if they don't understand asset management and property management and construction management, or they don't have somebody on their team who does, that they're going to find that 5 years from now, not only did they not make any money, but they wasted a whole lot of time and they may have put their investors at risk. So I would definitely recommend that new investors really focus on the operation side of things, or find a good partner who knows the operation side of things.
Absolutely. You're speaking my love language.
Mm-hmm.
What would you tell your younger self about real estate investing that you wish you knew then?
Yeah. Don't ever sell. So I know we do syndication and you do syndication, and it kind of puts you in a position where you have to sell because you have investors who want you to sell, but you're hopefully making a lot of money from those deals that you do sell. Take that money and put it into something you'd never sell. I flipped houses for 10 years. I flipped about 400 and some houses in that time, and I regret selling every single one of them. I look back today and they probably would have been worth another 30 or 40 or $50 million over what I sold them for. And I'm not saying that like I use that number to justify why I hate selling, but in any given market, you're going to make money over 10 years in appreciation. But if you're holding, not only are you making the money on appreciation, you're making the money on cash flow, your tenants are paying down your mortgages, and you're getting the tax benefits. And so there's just so many more benefits to holding real estate long-term than being transactional and flipping them. And I think the biggest mistakes that I've made have involved selling sooner than I should have.
Yeah, I think the longer you become a real estate investor, you tend to be, less transactional and more of a long-term holder, more of a gardener versus a hunter,
Exactly.
Yeah. Well, Jay, awesome having you on. Like I said, I love the Junk Real Estate Podcast.
I appreciate it.
Where can listeners find out more about you and your company?
Yeah, if you go to jscott.com, just the letter J, SCOTT.com, that'll link you out to everything you might want to know, or you can go to bardowninvestments.com, which is my company.
Awesome. Thanks so much. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.